Welcome back to the January 2026 edition of Let's Talk Markets. As always, it's our goal to educate, inform, and empower the families and businesses we serve. And so, if you find today's discussion valuable, which we hope you will, we encourage you to share it with others who might benefit from staying connected to what's happening in the markets and why it matters. And man, this month, we'll start by looking at what really drove the markets in 2025. Then we're going to take a step back and we're going to talk about why earnings remain the foundation of long-term market returns as we head into a new year. From there, we'll put recent performance into some perspective and close with a few remarkable moments from 2025 that's going to highlight the progress and innovation happening beyond the headlines. All right, so I'm excited about today, and we're first going to talk about what drove the market in 2025. Now, before we talk about how the markets finished this past year, it's worth noting and starting with how those returns were created. So I have a couple graphs here for you. When you look at the top 20 best performing stocks in the S&P 500 in 2025, the gains, they're eye-catching. You see the companies here? SanDisk, Western Digital, Micron, Seagate, and Lam Research posted extraordinary returns, in some cases up 200, 300%, or even more. You also saw some big moves from names like Palantir and Robinhood, which benefited from enthusiasm around AI, data, and market activity. CVS Health even made the top 20 performers on this list. So I thought it was a cool kind of graph to show you what those top performers were. But what was the common thread among many of the biggest winners? They were tied to technology infrastructure, semiconductors, storage, hardware, and the systems supporting AI and data growth. Now, let's compare that to the bottom 20 performers. And this might kind of surprise you. On that list, you'll find some pretty well-known names. United Health, Chipotle, Lululemon, FactSet, Clorox, and Constellation Brands, many of them down 30 to 40% or more. And that's the same year the index finished strongly positive. So even in a year where the market was up, individual outcomes were dramatically different depending upon what you owned. And when you put it all together, it leads directly into this month's of Ryan's market fact. And so let's dig a little bit deeper into his market fact. And what I thought was interesting about this, the title of it that he created was "The Market Was Up, but It Wasn't Broad." So that stock level dispersion that we kind of see here, it shows up clearly when you take a step back and you start to look at the market by different sectors, right? In 2025, information technology alone accounted for roughly 45% of the S&P 500's total return. That's nearly half. After tech, communication services contributed about 18%. Financials added roughly 12%, and industrials contributed close to 10%. Meanwhile, sectors like healthcare, consumer discretionary, and staples, they played a much smaller role despite making up a meaningful portion of the index. So it's kind of interesting to take a look at that. And the key takeaway is that 2025, no doubt, it was a strong year for the market, but it was driven by narrow leadership. Remember, 50% of it's coming from technology. A relatively small group of companies concentrated in a few sectors did most of the heavy lifting. And that's an important lens as we move forward. Headline index returns can look strong, but understanding what's beneath the surface matters just as much. So, with that context in mind, let's step back and look at how the major markets performed overall in 2025 and what the broader environment looks like heading into the new year. And I'll tell you, for this year, what we're saying, earnings are still the story. Let's take a step back, right? The headlines were loud. Tariffs, geopolitics, artificial intelligence, even a sharp pullback in the spring. We all remember it, right? At one point in early April of last year, the S&P 500 was down roughly 15% for the year. And sentiment shifted quickly. But by year end, the S&P 500 finished up double digits, marking its third consecutive double-digit return. I remember that on the Let's Talk Markets that we were talking about. The first quarter of last year was actually one of the worst quarters we had seen to start a year in the history of the markets. And look where it ended up. But what actually drove that outcome? What do we always say here on Let's Talk Markets? Two things drive markets over the long term. You remember? Earnings and interest rates. So take a look at this. You strip away the noise, and the market did what it almost always does over time. It followed profits. Earnings for the S&P 500 are expected to have grown a close to 13% in 2025. And expectations for 2026, earnings growth, they're even stronger, north of 15%. This chart actually shows that the 13.6% profit growth compared to the last 25 years. What can you tell from this? Companies are more profitable today than ever before in history. Now look at this. That combination, solid profit growth alongside some multiple expansion, it explains why returns have been so strong. And this chart shows over the last 15 years the earnings per share of the S&P 500. And I've always said earnings drive performance over time. And this chart looks very similar to the S&P 500 throughout the same period of time. But there is an important nuance underneath those headline numbers. That earnings growth has been highly concentrated, and we've talked about it on Let's Talk Markets. Large cap stocks did most of the heavy lifting. Let's look at that. Over the last 3 years, the S&P 500 earnings grew roughly 20%. Mid-cap earnings declined. Small cap earnings declined even more. International markets lagged as well. So that concentration explains much of what we discussed earlier. Narrow leadership, big dispersion, and a market that rewarded specific areas rather than broad participation. Now, here's where things get interesting heading into 2026. For the first time in several years, earnings growth is expected to broaden. Forecasts now show double-digit earnings growth, not just for large caps, but also for mid caps and small caps and even international stocks. Now, at the same time, large cap valuations, they're already elevated by historical standards, and we've talked about that at length in these Let's Talk Markets. That doesn't mean the story is broken, but it does mean future returns may rely more on earnings growth and less on valuation expansion. So in contrast, many of the areas that lagged over the last 3 years now trade at meaningful discounts, despite improving earning outlooks. So, as investors, why does this matter to me? Rather than chasing what worked best last year, the opportunity in 2026 may lie in where earnings growth is emerging next, especially in parts of the market that have been overlooked or underowned or even undervalued. And that really sets the stage for how we think about positioning portfolios going forward. Balancing participation and what's working today while staying prepared for leadership to evolve in the future. Okay, so our big discussion point for today. Let's put markets into some perspective. And as we start the year, it's always worth noting to kind of pause and zoom out, right? Especially after a run like we've just had. 2023 was a strong year. 2024 was a strong year. And 2025 was a strong year. That's 3 good years in a row. And it's not something we should ignore. It's exactly why perspective matters right now. So this is very telling. This goes a little bit more into bull and bear markets and why context matters. So let's start with the history of the U.S. bull and bear markets. One thing this chart reminds us of is how asymmetric markets tend to be historically. As you can see, bull markets last much longer than bear markets. bull market gains far outweigh bear market losses. Bull markets are longer, more powerful, and where most long-term wealth is built. But let's not forget, bear markets are painful, but they tend to be short. Let's just see, the recent bull market we've been in fits that historical pattern. Strong gains over time, interrupted by short, sharp periods of stress. And we saw that last year and 3 weeks back in April. Now, the other thing this shows, good years are normal, but so are bad ones, right? Look at the positive and negative year chart here. Since 1926, the market has been positive, are you ready for this? About 74% of the time. So negative years do happen about a quarter of the time, but they're the exception, not the rule. And that's important context coming off of 3 strong years. It doesn't mean a bad year is guaranteed, but it does mean we should expect more normal behavior, not straight line returns. All right, I love this chart. We call this time is the investor's advantage. The probability of positive returns slide, this drives it home, okay? The idea is if you invested in, let's just say 1 day, right? What's the percentage probability of investing in that 1 day that you would be up? As you can see here, it's basically a coin flip. What about if you invested for 1 month? Well, that's 6 out of 10 odds to be profitable. Pretty good. What about 1 year? If you invested for 1 year, that's 77.6% probability. Pretty good, but still noisy. Let's go out a little bit further. 5 years, take any 5-year period. Over a 90% probability of profit. 10 years, historically, you've had over a 97.5% probability of making positive returns in the market. This is why staying invested, with the right structure, of course, matters so much. And you can see, corrections are part of the deal. And let's talk about the history of market corrections. This chart uses the S&P 500 on the left and the Dow on the right. And you can see pullbacks of 5 to 10%, but the 10% happen almost every year. That's about 3 times a year, okay? Whereas 10 to 15% declines happen every couple of years. Declines of over 15% happen every few years. And we just lived through one of them back in April of 2025 when markets pulled back meaningfully before recovering. Corrections, they're not a sign that something is broken. They're a normal feature of investing. And here's the most important takeaway. Historically, they've created opportunity for disciplined investors. So, what does that mean for 2026? After 3 strong years, we're not expecting another outsized year. Believe me, I hope I'm wrong. I hope it is. But we're expecting a more modest return environment in 2026, which would be very consistent with history. What ultimately drives markets over time, and I'll say it again, earnings and interest rates. On the earnings front, we talked about it. You've seen it. Fundamentals remain strong. We'll continue to monitor closely for any disruptions in the earnings story because historically, that's one of the clearest signals that markets may start to struggle. What about on the interest rate front? We expect rates to continue trending lower through 2026, which would act as a meaningful tailwind for markets, supporting valuations and financial conditions. So just think about it. That combination, earnings holding up and rates easing, that supports the idea that volatility may show up along the way, but the longer-term foundation of the markets remains in a very solid place. So don't forget, discipline matters more after strong runs. At the end of last year, we spent an entire segment discussing what disciplined investing actually looks like. Y'all remember process over prediction, diversification, rebalancing, and aligning every investment with a purpose. If you missed that conversation, we'd encourage you to go back and watch our November edition of Let's Talk Markets on our YouTube page because we walk through that framework in detail. But after strong multi-year runs, remember, leadership can rotate, volatility can increase. The gap between winners and losers, they can widen. And that's when discipline matters the most because markets don't move in straight lines, even in healthy environments. So our focus is staying disciplined through all of it. Got to maintain balance. You stay aligned with your long-term goals. You've got to be thoughtful about positioning as conditions continue to evolve. Because that mindset, not reacting or chasing, but responding with a disciplined approach, is what we believe leads to better outcomes over time. That same spirit of discipline is what guides the way we review our portfolios as well. And it's not just for our clients, but for anyone seeking clarity. And so I know we've talked about it before, but when we offer our second opinion service, we're looking for the same thing we emphasize here: a disciplined structure, balanced risk, and purpose behind every position. Remember, it's a complimentary review that can help ensure investments are aligned, risk is balanced, and opportunities aren't being overlooked. And so we've seen firsthand how valuable this can be, especially in uncertain markets. And so if you have a friend, a family member, or a colleague who might benefit from this discussion, invite them to tune into Let's Talk Markets or connect with us directly anytime, because we'd be honored to help. Okay, this is going to be really fun. And this are some of the wow moments of 2025 that you may have missed. We've spent a lot of time talking about returns, earnings, volatility, and discipline. All of those are important. It's a great way to kind of start the year in 2026. But while 2025 was a strong year for markets, it was also a year of some quiet breakthroughs. And so I wanted to point out a few of them. A few of those wow moments, if you will, from 2025. And so the first one here, I don't know if you know this, but a private company landed on the moon. I actually didn't even hear about this in the news. For the first time in history, a commercial company, not a government, successfully landed a spacecraft on the moon. And the company is Firefly, and their Blue Ghost lunar lander. It successfully touched down on the moon this past year. Pretty cool, right? Look at that picture, too. I don't know how in the world that thing made it to the moon. The second one, this is crazy, but it's AI-designed drugs are actually entering human trials. In 2025, drugs designed by artificial intelligence moved from theory to reality, entering real human clinical trials. So think about it. What used to take years of trial and error is now being accelerated by AI models that can identify promising compounds faster and more efficiently. Crazy. Number 3, renewables quietly overtook coal globally. Last year, solar and wind energy generated more electricity globally than coal for the first time ever. What's remarkable is kind of how it happened, too. It's not through mandates or headlines, but it's actually through scale, through cost efficiency, and in engineering progress. Historic global energy shift crossed a tipping point last year, and I didn't even see it make any of the headlines. Number 4, this is what was really kind of blew me away. High-speed internet reached most of the world's remote areas. So satellite networks quietly delivered reliable, high-speed internet to regions that had never been connected. Right? Starlink, we've all seen it. Well, remote islands, mountain villages, even rural communities. For the first time, access to information is becoming geographically irrelevant. And that is a massive leap in global connectivity. So this image actually shows what these satellites look like in the night sky. And you can actually see these string of lights fairly frequently if it's a clear night sky. So that's not a UFO. If you thought it was a UFO, it's actually just Starlink out there. So those were just a few things we read throughout the year that made us just say, wow, the world keeps moving forward. Innovation keeps happening. And over time, markets have reflected that progress. We are so grateful you joined us today, and we encourage you to share this content with anyone who might find it valuable. We have all the replays of our Let's Talk Markets posted on our YouTube channel, and if you haven't checked it out yet, you definitely should. It's also home to our Beaver Nuggets and our podcast, Between the Bears and the Bulls. And we cannot wait to share with you our conversations with some amazing guests coming up this year. It's going to be a lot of fun. So please be on the lookout for those emails announcing the release of our upcoming episodes. They're assuredly, you don't want to miss them. And as always, if you have any suggestions on what you'd like to see from us, please let us know. We want to make sure the content that we're putting out there, it's valuable to you and to those that you care about. Oh, and one last thing. I learned this in 2025, and I had to tell you before I go, but what is the difference between a piano and a fish? You can't tune a fish. We'll see you in February for the next edition of Let's Talk Markets. And don't forget, leave it to Beavers.